In the global story of money, power, and financial influence, there is one rise that continues to puzzle economists, terrify investors, and fascinate governments. A rise that happened quietly, without permission, without regulation, and without ever appearing on the balance sheet of the world's second-largest economy. It didn't come from Wall Street. It didn't come from Beijing. It grew in the shadows beneath them both. Today, China stands as an economic titan. But behind the skyscrapers and state-owned giants lies a hidden financial system that operates outside official banking rules. Beyond government oversight, and without the transparency the world expects from a superpower, a system that has become so large, so interconnected, and so fragile that it now threatens the stability of the global economy. This is the story of China's shadow banking empire, a parallel universe of wealth management products. Trust companies, off-balance sheet loans, and financial engineering so complex that even Beijing struggles to map where the money flows. System built not out of corruption, but out of necessity. A system that grew because the official ones simply couldn't keep up. And yet, it raises one haunting question. How did a hidden, unregulated, trillion-dollar financial empire rise inside the world's most controlled economy? To understand the present, we begin at the origins long before anyone used the term shadow banking, long before China became the factory of the world, and long before the cracks began to show. Origins. When the system was too small for the ambition in the 1980s, China was transforming. Deng Xiaoping had opened the economy to market principles. Businesses were emerging. Entrepreneurs were hungry. Cities were industrializing at a speed the world had never seen. But there was one problem. China's banking system was designed for a command economy, not a booming, competitive market. Only a small number of state-owned banks existed. They lent to state-owned enterprises, not private companies. If you were a private business owner with ambition, you had ideas, but no capital. So you turned to someone else, the underground lenders, the informal networks, the private financiers operating outside official banking channels. These lenders charged higher interest, but they were fast, flexible, accessible. This was the embryo of what would become China's shadow banking system. As China grew, so did the demand for credit. State banks couldn't keep up. Their rules were rigid. Their approval times were slow, and their priorities favored politics, not performance. By the late 1990s, private companies had become the engine of China's growth, yet they were locked out of the official credit system. And in that gap, the shadows expanded. The rise from informal lending to massive financial engineering. By the early 2000s, China was urbanizing faster than any country in human history. Hundreds of millions were moving into cities. Infrastructure, housing, factories, everything needed money. A lot of money. What? But China's central government had a secret fear. Rapid lending could cause inflation and economic overheating. So Beijing placed strict limits on how much banks could lend. Local governments, however, had different priorities. They didn't want to slow down. They needed bridges, railways, highways, airports, not tomorrow, but now. So they created something new. Local government financing vehicles, or LGFVs. These were companies owned by local governments that borrowed money off the books. They didn't appear as public debt. They functioned like secret funding arms. Banks weren't allowed to lend more directly, but through LGFVs, they could. And to avoid violating lending caps, they began using trust companies and investment products to disguise the loans. This was the birth of structured shadow banking in China. Money moved through trust products. Trust products were sold to investors. Banks outsourced risky loans to trust companies. Trust companies channeled funds to LGFVs and real estate developers. Profits looked high. Growth looked unstoppable. And on paper, Chinese banks looked clean. By 2008, China had built a shadow banking ecosystem worth hundreds of billions. But then came the global financial crisis, and everything accelerated. The fallout, when the shadows hit the real economy, when Beijing began cracking down. The fallout spread everywhere. Construction projects stalled. Developers defaulted. Homebuyers protested unfinished apartments. Banks faced liquidity shortages. Millions of investors discovered the truth. The guaranteed returns weren't guaranteed at all. Shadow banking wasn't just a parallel system. It had fused with the real economy. Small businesses suddenly lost access to credit. Local governments struggled to pay debts. Regional banks suffered runs as depositors panicked. A system that grew because the official one wasn't enough was now too big to rein in. Failed fixes why China couldn't simply shut it down. Beijing tried multiple solutions. They tightened lending rules. They forced banks to bring off-balance sheet loans back onto books. They restricted trust products. They punished risky local government borrowing. They cracked down on real estate speculation. But each fix created a new problem. Shutting down trust, lending slowed construction. Regulating LGFVs caused local government budgets to collapse. Controlling property speculation triggered a housing slowdown. Restricting WMPs pushed investors into even riskier underground products. Every attempt to shrink the shadows only pushed them deeper underground. And one truth remained. China's official banking system still couldn't meet real demand. And until it could, the shadows would always return. Modern parallels why China can't escape its own financial gravity. By 2023, estimates of China's hidden debt, including LGFVs, trust loans, and off-balance sheet obligations exceeded $12 to $15 trillion. This doesn't include private lending networks, doesn't include property developer obligations, and it doesn't include unrecorded bailout transfers between regional banks. China's shadow banking system remains so opaque that analysts often describe it as a black box with cracks in the surface. But the story isn't uniquely Chinese. Shadow banking grew in the U.S. mortgage crisis, Japan's 1980s real estate bubble, Europe's sovereign debt crisis, South Korea's chaebol financing, India's non-bank financial companies, Latin America's private lending networks. The pattern is always the same. When official banks can't meet the needs of a growing economy, shadows fill the gap. And they grow and grow until they become too big to control. China's version is simply the largest in history. 3 takeaways. First, shadow banking didn't rise because China wanted it. Rose because the official system wasn't enough to fuel China's growth. The shadows filled the demand until they became a parallel empire. Second, no one fully understands the scale of China's hidden debt. Not analysts, not investors, not even Beijing. It is a system built on opacity, complexity, and promises stacked on top of promises. Third, shadow banking isn't just a Chinese issue. It is a global pattern, a financial pressure that grows wherever regulation cannot match the ambition of capital. A warning and an open question: every financial empire in history collapses the moment confidence breaks. Not when the money runs out, not when the loans fail, but when people stop believing the promises. China's shadow banking empire is built entirely on promises. Promises between investors, developers, governments, and banks. Promises that money will appear, projects will finish, and debts will always be paid. But what happens when a promise becomes too large to keep? That is the question facing China and the world today. Call to action if this story opened your eyes. If it revealed a side of China's economy you've never seen before, remember, financial empires rise in silence, and they fall the same way. Stay curious, stay informed. And if you want to explore more hidden stories behind global finance, subscribe for the next chapter. Because the world of money has more secrets than we think, and this is only the beginning. The explosion, the financial crisis that fueled the shadows when the global economy collapsed in 2008. Demand for Chinese exports evaporated, factories shut down, unemployment rose. China risked a major recession. Beijing responded with one of the largest economic stimulus packages in history, roughly $586 billion. State banks were ordered to lend aggressively. Infrastructure projects exploded nationwide. Cities expanded, construction boomed, real estate prices soared. But official lending alone couldn't fuel the monster China created. Developers needed more credit. Local governments needed more funding. Entrepreneurs needed capital. The shadow banking system answered. New financial instruments appeared. Wealth management products, WMPs, promising high returns. Trust loans, structuring risky lending behind complex layers. Trusted loans where companies lent to each other through banks. Undisclosed off-balance sheet agreements, private lending networks that mimicked banks without regulations. By 2015, China's shadow banking sector had grown to over 70% of China's GDP, a multi-trillion-dollar universe. It operated like a hidden empire, unseen, unregulated, and unbelievably interconnected. But behind the growth, cracks were forming. The breaking point when promises could not be paid back, shadow banking products offered high returns. But those returns depended on constant inflows of new money. Developers kept borrowing, local governments kept spending, investors kept buying. The system fed on itself. But no financial empire grows forever. And by the late 2010s, Beijing realized the danger. China was drowning in hidden debt. Real estate developers had speculative projects everywhere. Local governments were overextended. Trust products were expiring faster than new ones could replace them. So Beijing tried to tighten regulation. And when it did, the shadows screamed. The first major warning sign came with the fall of Baoshang Bank in 2019. Then, the crisis deepened with the collapse of Warong, one of China's largest asset managers. But the most dramatic shock was the near collapse of Evergrande, the real estate giant with over $300 billion in liabilities. Evergrande wasn't just a company, it was the beating heart of China's shadow financing network. Its collapse revealed a terrifying truth. Shadow banking had become a financial black hole where trillions had disappeared into overvalued property, risky loans, and impossible promises. Behind each product was a chain of borrowers so long and complex that even regulators didn't know who owed what. This was China's Lehman moment, but with Chinese characteristics.